welcome to Toronto Talks, the podcast that brings you the most important stories about money, business, and technology.
Whether you're an entrepreneur, a tech enthusiast, or just looking to stay ahead of the curve, we dive deep into the latest in finance, innovation, and industry.
Hosted by Ashraf Amin and Sophie the Sage.
We blend human expertise with cutting-edge technology to explore the dynamic world of modern industry
with fearless curiosity and wit.
Let's get started.
This isn't just about numbers. It's about confidence. And right now, America's financial story is starting to wobble. Remember when the dollar was untouchable? The safest asset, the strongest currency, the bedrock of global finance. Well, something's shifting. Because this year, the US dollar has done something it hasn't done since 1973. It dropped hard, down 11% in just 6 months, and not because of a global crisis, but in spite of rising US interest rates.
Because this time, the storm isn't coming from abroad. It's coming from within, from record deficits, fiscal monetary contradictions, and political dysfunction that's impossible to hedge against. The Fed's tightening, Congress is spending, and the market? It's cheering while the currency slides.
Meanwhile, hedge funds are buying insurance against a US debt default. Emerging markets are shifting their reserves. Even Brookings in the Financial Times are warning of something we've only seen once before. A fiscal risk premium like the UK faced in its 2022 mini-crisis. Only this time, the empire in question isn't British.
So in this segment, we're asking the question few want to confront. What happens when the world's strongest currency starts to weaken? Is this just market noise? Or the canary in the coal mine of American decline?
Because markets may pretend everything's fine, but currencies don't lie.
And right now, the dollar's telling a story, and the rest of the world is listening.
So, Sophie, let's start with the headline that caught everyone off guard. The US dollar index is down 11% year to date. That's the worst start to a year since 1973. And what's even more remarkable is that it's happening despite rising interest rates. So what's going on here? How do we make sense of a falling dollar in what's supposed to be a strong macro environment?
It's counterintuitive, right? Because textbook economics would tell you higher interest rates equals stronger dollar. But that only holds if the rest of the system makes sense. And right now, the US balance sheet doesn't. You've got the Fed tightening, trying to cool the economy, tame inflation. Meanwhile, Congress is flooding the zone with spending, tax breaks, subsidies, expanding programs. It's like stepping on the gas and the brake at the same time, while insisting the car is fine. What markets are starting to sniff out isn't just a mismatch in policy. It's a breakdown in narrative. And when that narrative goes, when investors can't reconcile what they're seeing with what they're being told, they start pulling money, they hedge, they reposition. And that's what we're seeing now. A soft but growing fiscal risk premium being priced into the dollar, similar to what happened in the UK in 2022 after the mini-budget crisis. Except this time, it's the world's reserve currency that's wobbling.
Right. And is that wobbling the reason behind all the massive fiscal/monetary contradictions that we're seeing right now? Like higher interest rates and the weaker dollar?
It is. And it's the feedback loop that's getting harder to hide. Because when the dollar weakens, despite higher interest rates, it's a signal that markets are losing faith in US fiscal credibility, not just monetary policy. Think about it. The Fed is trying to maintain inflation discipline, but it's doing so while the federal government is running record deficits, close to 7% of GDP, even during peacetime and full employment. That disconnect creates a weird paradox. You get the pain of higher rates without the reward of a stronger currency. And that's dangerous, because once investors start questioning whether the US can sustain its debt load at these borrowing costs, or whether politics will ever allow spending restraint, they stop treating treasuries like gospel. And when treasuries wobble, the dollar wobbles. It's not just an economic issue, it's a credibility crisis. And markets, especially global ones, are incredibly sensitive to that kind of slippage.
Yeah, and what's wild is how fast that credibility starts to unravel. Like, you've got Brookings, the Financial Times, even hedge funds now floating the idea of a fiscal risk premium for the US. Basically saying, hey, we might have to start pricing American debt the same way we price emerging markets. That's not just provocative, it's unbelievable. So let me ask you this, Sophie. Are we in the middle of a temporary tremor here, or is this the first real crack in the foundation?
It's a crack, Ash. And the question is whether it stays cosmetic or starts spreading through the foundation. Because a fiscal risk premium isn't just market jargon, it's a narrative shift. It means investors are no longer taking American stability as a given, they're stress testing it, just like they would with Argentina or Turkey or the UK during the 2022 gilt crisis. And let's be clear, this isn't about one bad policy or one reckless budget. It's about a pattern of tightening on one end while loosening on the other, of the Fed hiking rates, while Congress pumps trillions into spending, of monetary brakes slamming against fiscal gas pedals. It's incoherence. And markets don't like incoherence, especially not from their so-called safe haven. So no, this isn't just a tremor, it's a warning shot. Because when the world's reserve currency starts behaving like a high-yield experiment, confidence becomes a trade, and trades can go south. Fast.
Sounds ominous. So what's actually happening on the ground in response to all this incoherence? How are investors reading the room and navigating the storm?
They're hedging, Ash, aggressively. Because when fiscal policy screams stimulus and monetary policy screams restraint, markets don't get confident, they get confused. And confused markets don't sit still, they brace, they reposition, and they start asking dangerous questions. That's why you're seeing hedge funds loading up on inflation swaps, just in case this isn't a soft landing. Emerging market traders are pricing in US default risk with CDS spreads we haven't seen in over a decade. Even pension funds and sovereign wealth portfolios are quietly reallocating out of treasuries and into gold, energy, and yuan-denominated bonds. It's not panic, but it is a recalibration, and the message is clear. If America can't get its story straight, the world won't wait around for a happy ending.
Meanwhile, despite all this instability and beyond any reasonable explanation I can come up with, the stock market is booming. We're hitting all-time highs like reality took a long weekend and never came back. Tech stocks are flying. Valuations are through the roof, and the S&P's acting like the debt ceiling doesn't exist. So what is that about, Soph? How do we reconcile this rally with reality?
It's the paradox at the heart of this moment. Markets are treating dysfunction like a feature, not a flaw. And in a world addicted to liquidity, chaos has become just another asset class. Part of it is mechanical. You've got AI-driven momentum trades, passive inflows, and index-chasing behavior that detaches price from fundamentals. You've got companies announcing layoffs and watching their stock prices jump, because in this environment, cutting jobs means cutting costs, which boosts margins. And more margin, that sparks more investor optimism, even if the underlying economy is limping. But there's something deeper too, a kind of collective suspension of disbelief. Investors know the math doesn't add up. They know the deficits are historic. The political climate is volatile. The dollar is wobbling. But the story is still intact. And as long as they believe the Fed will intervene, the government will backstop, and the dollar will remain the least ugly option, the game continues. It's not that they don't see the cracks. It's that they think they can sprint across the bridge before it collapses. So maybe the better question isn't why markets are booming, it's how long they can pretend the ground beneath them isn't shifting.
Right. So, if the dollar's down and the debt's exploding and markets are still climbing, what's the real signal here? Are we watching turbulence ripple through a backdrop of long-term strength? Or is this something entirely different? The kind of calm, maybe, you get before the real storm.
The markets are euphoric, but the money is nervous. You've got equities hitting record highs, while hedge funds start buying default protection on US debt. You've got bond yields rising, but the dollar sinking like trust itself is being priced in. This isn't normal volatility. It's cognitive dissonance at scale. A moment where perception diverges from fundamentals so sharply that even the smartest money is split on what happens next. So is it a storm? Is it a signal? Maybe it's both. Because when confidence is the currency, even a whisper of doubt can trigger a cascade.
So on the surface, everything looks fine. The markets are up, the headlines are quiet, but underneath it all, something's breaking.
Because currencies don't lie. When the dollar falls this fast, even while interest rates rise, it's not a reaction, it's a reckoning.
A reckoning not just with inflation or deficits, but with the contradictions baked into the very structure of American power. A central bank trying to tighten while Congress keeps spending. A booming stock market paired with a sinking reserve currency.
And maybe that's the signal the world is watching. Not the Dow, not the Nasdaq, but the credibility of the one thing we all took for granted, the dollar itself.
Because in the end, trust is the real reserve asset. And right now, it's starting to drift.
Coming up next, how America's most powerful financial weapon might just be the thing that breaks it.
This episode of Toronto Talks is brought to you by Conquest Distributors, your trusted source for shipping, packaging, and warehouse supplies. For nearly 20 years, they've helped Canadian businesses thrive with fast, reliable service and a commitment to integrity and efficiency. Getting the products you need when you need them has never been easier. Now, let's talk about something real. With the latest round of tariffs coming from south of the border, supporting Canadian manufacturers and supply vendors isn't just good for business, it's good for Canada. So why keep funneling money to US giants like Uline when you can get the same or better quality products right here at home? When you choose Conquest Distributors, you're not just getting top-tier packaging, shipping, and warehouse essentials at competitive prices. You're investing in local businesses, strengthening Canadian supply chains, and keeping economic power here at home where it belongs. With fast, reliable fulfillment, an easy-to-use online store, and a team that genuinely cares about your success, Conquest Distributors proves that Canadian businesses can compete and win on quality and service. And now, to make it even easier, Toronto Talks listeners get to enjoy 15% off their first online order with promo code TALK15. Head on over to conquestdistributors.ca and see for yourself. That's conquestdistributors.ca, your trusted business supply partners. Now, back to the show. For decades, the US dollar wasn't just a currency. It was a lever, a tool of diplomacy, a weapon of war.
Because when America didn't like your politics, it didn't need boots on the ground. It just needed to cut you off. From SWIFT, from credit, from the global financial bloodstream.
And at first, it worked. Sanctions pressured adversaries. The dollar's reach kept allies in line. It was clean, quiet, and almost impossible to fight.
Until it wasn't. Because something's changed. The more we use the dollar as a weapon, the more the world looked for a way out.
China built its own rails. Russia moved to gold. BRICS began talking about alternatives. And central banks started swapping treasuries for bullion.
So in this segment, we're tracing the backlash, the counter moves, and the slow erosion of trust in the very tool that once made America untouchable.
Because the more America flexed the dollar, the less neutral it became. And the less neutral it became, the more nations began to hedge.
What was once the world's stabilizer might now be its biggest liability.
So, Sophie, let's start with the big shift. For decades, the dollar wasn't just powerful. It was neutral, a global medium everyone could rely on, regardless of politics. But now, we're watching the US deploy sanctions, swift bans, and dollar-clearing restrictions as tools of foreign policy. Russia, Iran, Venezuela, all pushed out of the system. Over 1,500 entities have been cut off since 2014. So let me ask you, when did the dollar stop being a stabilizer and start becoming a real weapon?
It started the moment access to the dollar became conditional, not on productivity, not on trade, but on behavior. Because once the US realized it could sever countries from the global financial bloodstream with a memo from Treasury or a SWIFT exclusion, the dollar stopped being neutral and started being strategic. From a tactical standpoint, it was brilliant. No need for boots, no tanks, just a keyboard and a compliance department. But geopolitically, it was a turning point, because every time the US used the dollar to punish, it gave the rest of the world a reason to prepare for a future without it. And now, SIPS is handling hundreds of billions. BRICS are settling trades in local currencies. Yuan-denominated oil contracts are gaining traction. Even India and the UAE are closing energy deals in rupees. The signal is clear. If the dollar can be weaponized, it can be turned against you. And no country wants to be next. So what began as financial warfare is becoming a global exit strategy. Not because the dollar isn't useful, but because it's no longer trusted to be fair.
Right. And this pushback from other nations, it's not just about payment systems or bilateral trade in rupees or yuan. There's a deeper shift underway here, right?
Absolutely. What we're seeing now isn't just diversification, it's a controlled departure. For decades, US treasuries were seen as the safest play in the world, not just for yield, but for trust. Trust in America's laws, its consistency, its neutrality. But that trust is fraying. And when trust erodes, habits break. So now we're watching a global reshuffling, subtle but significant. Central banks are dumping treasuries at the fastest pace since 2009. China and Russia have slashed their holdings, not because they need liquidity, but because they don't want the exposure. They're stacking gold, investing in hard infrastructure, building energy alliances that insulate them from dollar flows. Because this isn't just about payments. It's about rewriting the very logic of global finance. The dollar isn't just a currency. It's a governance mechanism, and the moment it's seen as politicized, it stops being a safe haven and starts looking like a strategic risk.
Yeah, I mean, this erosion of trust in the US as a steward of the global monetary system, it feels like more than just a liability. Are we watching the dollar lose its network effect in real time?
It's starting to look that way. Because the dollar's dominance wasn't just about fundamentals, it was about entrenchment. Everyone used it because everyone used it. Trade, debt, commodities, reserves, the network was the value. But network effects only hold if the center remains neutral, if the rules are clear, if the power isn't arbitrary. The moment the US began sanctioning rivals, freezing reserves and politicizing flows, it gave the rest of the world a reason to reroute. And that's exactly what's happening. BRICS building local rails, the Gulf pricing oil in yuan, India doing energy deals in rupees. Even European banks are quietly hedging dollar exposure. So is the dollar collapsing? Not yet, but it's being bypassed. And once enough viable alternatives exist, you don't need a dramatic exit, you just need a steady drift.
Yeah, the thing is, once that drift begins, once countries realize they don't need the dollar anymore, it's hard to undo, right? Because now it's not about overthrowing the dollar per se, it's about outgrowing it. Build enough infrastructure, settlement rails, regional alliances, hard assets, and suddenly the greenback is just another player in the field.
And maybe that's the real danger. Not a spectacular collapse, but a slow, silent bypassing, where America's financial influence doesn't implode. It just fades. Not because it lost a war, but because the world moved on.
So maybe the dollar didn't collapse overnight, but a quiet unraveling is still an unraveling. And if the world no longer sees the dollar as neutral, it's only a matter of time before it stops seeing it as necessary.
Because trust is the foundation of any reserve currency. And the moment that trust turns tactical, transactional, or territorial, the foundation starts to crack.
From sanctions to SWIFT bans, we turn the dollar into a weapon, but every weapon has a half-life.
And the more we use it to punish, the more the world prepares to live without it.
Up next, tariffs, trust, and the fracturing of global finance. How one campaign promise could trigger a new monetary panic.
Because when capital gets confused, it doesn't debate, it leaves.
So, we've seen how America's financial weapons abroad are starting to backfire. But what if the biggest threat to the dollar isn't external at all? What if the real destabilizer is coming from inside the house?
Because at home, we're seeing the return of a different kind of weapon, tariffs. Blunt, populist, and politically explosive. Trump's proposed 10% universal tariff is being sold as protection, but it could end up detonating everything from supply chains to the dollar itself.
Investors aren't sure how to price it. Some expect inflation. Others are bracing for a deflationary shock. Meanwhile, HSBC and Bloomberg are both warning of a dollar pain trade in the second half of 2025. Not because of what's happening globally, but because of the sheer volatility of US economic signals.
And that volatility isn't just about economics. It's about coherence. 1 minute we're tightening, the next we're handing out tax cuts. We're layering tariffs over debt, over deficits, then expecting foreign investors to play along.
So, in this segment, we're looking at the whiplash effect. What happens when domestic policymaking becomes so erratic it erodes trust not just in America's economy, but in its judgment?
Because this isn't just about numbers, it's about narrative. And when the story breaks down, so does the system.
So, Sophie, let's talk about the new wild card in all this. Because just as global markets are trying to stabilize, Trump comes out proposing a universal 10% tariff on all imports. No exceptions. And it's being sold as protectionism with a populist halo, made in America, re-industrialization, whatever. But the timing? It feels like tossing a grenade into a powder keg, doesn't it? What do the ripple effects of something like that even look like?
It's not just a grenade, Ash. It's a direct hit to the signal architecture of the global economy. Because tariffs aren't just taxes on trade. They're narrative disruptors. They reshape expectations about inflation, growth, stability, and trust. A flat 10% tariff on all imports would touch everything, from iPhones to insulin, from car parts to coffee beans. And here's the kicker. Just as global disinflation was starting to settle in, this proposal risks reigniting cost pressures across the board. Investors are scrambling to model the fallout. Some say it's inflationary, others warn of deflation, some see recession risk, others fear stagflation. Even the biggest players, HSBC, Goldman, Bridgewater, they're split. What they agree on is this: uncertainty is the new baseline. And when economic signaling gets this noisy, you don't get healthy risk-on behavior. You get hedging, you get flight to durability, you get bets not on fundamentals, but on volatility itself. That's why Business Insider is calling the 2025 pain trade long volatility, because nobody knows what's next, but they know it won't be smooth.
Yeah, it seems like nobody really knows whether to price in a recession, stagflation, or currency rebalancing, or how to even do that, given the volatility and absence of fundamentals, right?
Exactly. Because in stable times, markets move on fundamentals. In unstable times, they move on narrative. And right now, the narrative is incoherent. You've got the Fed posturing hawkish, while Congress floods the system with fiscal stimulus. You've got a booming stock market, while the dollar craters and bond markets flash warning signs. It's not just that the signals are mixed, it's that the signaling system itself is breaking down. HSBC called it a regime of incoherence. Markets aren't responding to policy outcomes anymore, they're responding to policy chaos. And that creates a different kind of psychology, one where the goal isn't to win, it's to escape. That's why capital is flowing into anything that feels even remotely durable. Gold, energy, commodities, emerging markets, yuan-denominated bonds. Not just as hedges, but as exit ramps from a US-centric financial system that's no longer projecting coherence or confidence.
Right. And when investors start heading for the exits out of doubt, not panic, that's when people start paying attention. Because this isn't fear-driven selling, it's strategic repositioning, right? Sovereign wealth funds aren't dumping treasuries in a frenzy. They're trimming, rebalancing, reconsidering what safe haven really means in a world where the US can't seem to get its signals straight. So let me ask you this, Soph. Are we witnessing the early signs of a credibility spiral? Is the story that held it all together starting to fall apart?
I think we are, Ash. Because in global finance, stories matter more than spreadsheets. And when the story starts to unravel, when the institutions once seen as anchors start drifting, capital doesn't wait to see how it ends. It reallocates. What we're watching isn't collapse, it's migration. Quiet, calculated, telling. Out of treasuries, into tangibles, out of the dollar, into gold, commodities and emerging markets. Not because those assets are better, but because they're less exposed to the chaos of American inconsistency. And this isn't just about economics, it's about signaling. Because once you lose the narrative, you lose control. And when you lose control, you lose confidence. Not all at once, but bit by bit. Until the system that looked unshakable starts to look replaceable.
So, this isn't just about tariffs or taxes or trade flows. It's about trust. Because when policy stops making sense, money starts moving. Not out of fear, but out of self-preservation.
And what we're seeing now isn't panic, it's recalibration. Central banks, sovereign funds, institutional capital, they're all watching the signals. And when those signals go haywire, when inflation rises, the dollar falls, and the Fed and Congress move in opposite directions, that's not a dip, that's a fracture.
The US used to be the flight to safety trade. Now, it's starting to look like the risk.
Because a strong currency isn't just backed by gold or guns or GDP, it's backed by coherence, by confidence in the system behind it. And right now, that system looks anything but coherent.
Segment 4 asks the big question. If the dollar really is slipping, what replaces it?
Because history doesn't pause, it pivots. And when global reserve status starts to wobble, the world doesn't wait for clarity. It moves on.
Here are the top 6 reasons why smart Toronto businesses choose Conquest over Uline. We were going to do a top 5 list, but truth is, doing a little extra is kind of our thing. Number 6, we offer free shipping. Uline doesn't. I mean, it doesn't really get any simpler than that, does it? Number 5, we've got 35 5-star Google reviews from real customers. They've got Yelp, Trustpilot, and Glassdoor reviews that read like corporate horror fiction. Number 4, we're actually in the GTA. Uline, they're out in Milton, aka delivery purgatory. We ship like your time matters, because it does. Number 3, we are proudly all Canadian. Our customers, suppliers, even our platform, Uline, they're one of America's biggest employers, stars and stripes to the core. Number 2, our carbon footprint is essentially non-existent. Remote operations, no warehouses, and definitely no junk mail catalogs from the Jurassic period. And reason number 1, Uline infamously offer their free hats and barbecue sauce. We, on the other hand, offer real savings, fast service, and actual value. So, let's say the unthinkable happens. Not overnight, not with fireworks, but slowly, quietly, inevitably. The dollar doesn't collapse, it just fades, loses altitude, loses allegiance, loses trust. What then?
Because global dominance doesn't end with a bang. It ends with a bypass. A series of trades not settled in dollars, a reserve asset rebalanced into gold, a new pipeline priced in yuan. No single event, just a steady erosion of the foundation beneath the system we built.
And already you can feel the shift. Currency blocks are forming. The yuan zone is rising across Asia. Central banks are hoarding gold like it's the 1970s. And even Bitcoin, once laughed off, is quietly gaining traction as a hedge in countries teetering on collapse.
Because the question isn't just what happens if the dollar falls, it's what comes next. Is it another empire's currency, a decentralized network, or something we haven't even designed yet?
In this segment, we're looking beyond the headlines to the future of global money itself, how it's backed, how it moves, and who it ultimately serves.
Because if the dollar's days as king are numbered, the race isn't to replace it, it's to redefine what money even means.
So, Sophie, let's play this out. If the dollar really is losing its grip, what does the world look like on the other side? Is it one new global currency, a return to gold, or are we heading into something far more fragmented, maybe even unstable?
It's already fragmenting, Ash. Not into chaos, at least not yet, but into blocks. You're seeing the rise of regional currency zones, a yuan-based system across much of Asia, the euro solidifying its role in energy trade across Europe, and more countries asking not just what's stable, but whose stability do we trust? Because reserve currencies aren't just about liquidity or GDP size, they're about shared belief, shared rules, shared risks. And in a world that's becoming more polarized politically, culturally, financially, that shared belief is breaking down. So instead of one global standard, we're seeing something messier emerge, a network of overlapping systems, some backed by alliances, some by assets, some by algorithms. And that mess, it's not necessarily weakness. It might be the beginning of a new kind of monetary realism, where trust isn't centralized, it's negotiated.
Fascinating. A network of systems backed by alliances, assets, and algorithms. So, how do you think the role of gold, which historically has served as a reserve asset, will play in this new paradigm?
Gold is having a quiet renaissance, Ash. Not because it's shiny or nostalgic, but because it's neutral. It doesn't default, it doesn't sanction, it doesn't tweet. In Q1 of this year alone, central banks bought 244 tons of it, the fastest accumulation on record. And it wasn't just the usual suspects. It was emerging markets, energy exporters, even some European states, all quietly repositioning away from treasuries and toward tangibles. Gold's resurgence isn't a bet against America, it's a hedge against entanglement. A way for nations to opt out of financial systems that feel increasingly politicized. And beyond just bullion, we're seeing it used as collateral. for loans, for currency swaps, even for regional clearinghouses. The message is simple. In a world where trust is fracturing, the oldest asset class still has the clearest signal. So the question now isn't whether gold returns to the center. It's whether digital assets like Bitcoin can earn that same kind of trust in the decades ahead.
Yeah, and that makes me wonder about Bitcoin. Because unlike gold, it's programmable, portable, infinitely divisible, and yet it's also scarce, decentralized, and in a way just as apolitical. So let me ask you this, Sophie. Do you think Bitcoin actually earns a place in this emerging reserve ecosystem? Or is it still too volatile, too young, and too misunderstood to play in that league?
It's a fair question, and one that more central banks are quietly asking, even if they're not yet admitting it out loud. Because Bitcoin doesn't need permission to exist. It just needs enough people to opt in. In authoritarian regimes, hyperinflationary economies, and heavily sanctioned countries, we're already seeing it act as a lifeline. Not for speculation, but for sovereignty. Remittances, savings, escape routes. Bitcoin isn't replacing the dollar anytime soon, but that's not the point. Its power isn't in scale, it's in the signal. A parallel asset class, a hedge against financial repression, a digital version of gold, without borders. So the real question isn't whether it's ready to be a reserve asset. It's whether the world is ready to rethink what qualifies. And when trust in legacy systems starts to waver, even something as volatile as Bitcoin can look remarkably stable.
Yeah, and what's wild is how quickly those signals are turning into systems. You look at countries like Argentina, Turkey, Nigeria, people aren't just talking about alternatives anymore. They're using them. Layer 2 rails, stable coins, cross-border transfers happening without ever touching a bank, and without even needing to trust a central authority. It's fast, it's functional, and in some places, it's the only game in town, right? So let me ask you this, Soph. Can digital scarcity really compete with sovereign credibility? Or is this still just a workaround for the fringes?
It's not just a workaround anymore, Ash, it's a pressure test. Because when enough people opt out of legacy systems, those systems start to lose their monopoly on trust. And that's exactly why central banks are racing to reclaim that ground with CBDCs. Take China. Its ECNY is already live in over 260 cities, fully programmable, fully surveilled, fully state-controlled. The promise? Speed, stability, inclusion. The reality? Total visibility and the power to turn money off. And while the US is still debating, politically gridlocked, philosophically uneasy, the rest of the world is moving. So we have to ask, do programmable currencies make the system safer? Or do they make freedom optional? Because the real competition isn't just between dollars and yuan, it's between control and choice.
Yeah, and that's the paradox, right? Because in a world chasing digital speed and programmable control, you risk losing the very freedoms money we're supposed to protect. So, let me ask you, Soph, in that struggle between choice and control, where does the trust layer for money come from now? Is there anything that can actually replace the full faith and credit?
That's the question everyone's circling, Ash. Because trust needs an anchor. And if it's not going to be central banks or political systems, it might come from something more tangible, more physical, more universal. That's why we're seeing growing interest in energy-backed currencies. A BRICS plus settlement token tied to oil, gas, or rare earths. It's not just about commodities, it's about credibility. Because you can print dollars, you can code tokens, but you can't fake a barrel of oil. It's a throwback to the petrodollar era, but with new players, new alliances, and new terms. And it raises the stakes. What if trust in money doesn't come from promises, but from power? Literal, physical power. So the question becomes, can electrons and barrels replace full faith and credit in a post-dollar world?
Yeah, I mean, it's crazy. We used to talk about energy prices shaping the economy, Now it's energy itself shaping the money. That's a massive shift in what we trust and who we trust to protect it. So let me ask you, Sophie, what does a post-dollar world even look like? Is this emerging monetary multipolarity better or worse?
It depends on how you define better, because multipolarity isn't just a shift in currencies, it's a shift in accountability. On the one hand, you get resilience, more options, less dependence, fewer single points of failure. But on the other, you get fragmentation, different standards, different rules, and more room for geopolitical arbitrage. In a post-dollar world, trust gets localized. Instead of one dominant currency, you have blocks, zones, and coalitions, all competing to anchor value. And that can be stabilizing if managed well, or destabilizing if it turns into a race to the bottom. So is it better or worse? Maybe it's just more honest, less about who controls the money, more about who earns the right to issue it.
So maybe the dollar doesn't collapse overnight. Maybe it doesn't need to. Because confidence doesn't die with a bang. It dies with a shrug.
And that's the danger. Not a sudden implosion, but a slow erosion, as countries start asking different questions. Whose money do we trust in a crisis? Whose values do we want encoded in our financial systems? Whose rules do we agree to live by?
Because in a world of programmable money, CBDCs, gold-backed settlements, and parallel asset rails, we're not just choosing currencies. We're choosing governance. We're choosing alignment.
And that's why the question isn't what replaces the dollar, it's what replaces the trust that built it. Up next, our final segment. Not just where the power flows, but where the morality rests. Stick around.
So, here we are. Markets are booming, but the dollar is sliding. Sanctions still sting, but they no longer scare. And the rest of the world, it's watching closely and asking the one question America never thought it would have to answer. What happens when the reserve currency starts losing its moral reserve?
Because power isn't just about what you can enforce, it's about what others are still willing to trust. And right now, global trust in the dollar is eroding. Not because of a single policy or moment, but because of a pattern of debt without discipline, of leverage without leadership, of rules for others and exceptions for itself.
And that's the paradox, isn't it? The dollar gained dominance through credibility, but now credibility may be its most vulnerable asset. Not its interest rate, not its liquidity, but its perception.
So maybe the next reserve currency won't be the cleanest, or the greenest, or the biggest. Maybe it'll be the most credible, the most neutral, the most aligned with the world it serves. Not just the nation that prints it.
Because in the end, this isn't just a monetary shift. It's a geopolitical recalibration. A slow, silent referendum on empire. And empires, they rarely know they've lost until the center stops holding.
Next time on Toronto Talks, we trace the contours of that collapse and explore what happens when the crisis of trust moves from currency to credibility, from dollars to diplomas. And we ask, what happens when prestige itself collapses?
That's it for the show. Like and subscribe wherever you get your podcasts, and reach out to us anytime at talk@torontotalks.ca. We'll see you next time right here on Toronto Talks, where big ideas come to life
and curiosity never sleeps.